Well, happy Monday to you. So, what will the feds do to rates this week? That and a lot more today in the weekly mortgage rate recap and forecast. And I actually have a lot to cover, so please forgive me if I refer to my notes at all because I want to get most of this stuff that's going on in. And I'm James Hecker, mortgage advisor, NMLS number 214601. And so the first thing is, what did rates do last week? Well, mortgage rates increased ever so slightly last week, and they're kind of stable really at this time. And some of the factors that are causing that is surprisingly some economic growth numbers. First of all, the Feds. The Feds this week will be meeting tomorrow on Tuesday and finishing up on Wednesday when they announce their anticipated increase to the federal funds rate. Now, they raised the rate 4 times in a row, 0.75%, and then last time they raised it 0.5%. It's actually expected that they're only going to raise 0.25% at this meeting. And then again at the meeting in March, we're expected to see another 0.25%. Now, they may still raise it 0.5%, but the market is priced in about a 0.25% increase to the Fed funds. And so that means that the Feds are feeling confident that their actions are taming inflation. And I'd said before, it may not feel like that when you go to the grocery store, but overall, there's some indicators that show that. And so, some of the things that are affecting the market are, first of all, the numbers came out for 2022. And we had a increase in the third quarter of 2022 in economic growth. And we also had an increase, a little bit less of an increase, but still an increase in the last quarter of 2022. That came out at about 2.9% growth when it was expected about 2.6. And then the other thing that's affecting the market as well is unemployment. The unemployment numbers came out with less people filing for unemployment. And that seems a little bit, contradictory to some of the things that we're reading about layoffs. Google laid off, 12,000 people recently. So there's a lot of tech companies laying off, and some other companies can probably be laying off as well. But unemployment lines are shorter. Unemployment claims are less. And normally that would be bad news for interest rates, but it's actually kind of helping a little bit in the market right now. So in addition to that, home buyers' confidence is up a little bit as well. Prices for materials going into new homes is somewhat decreasing. And so there's a lot of things that generally good indicators in the economy are bad for interest rates, but we think that interest rates are kind of stabilizing because, again, signs of inflation are decreasing. And so that's important to see where we go from here with rates. Now, another thing that's going to affect rates a little bit further out is something called LLPA. That's loan level price adjustment. So the buyers of most loans after we do a home loan they're securitized and sold to Freddie Mac or Fannie Mae. Government loans, FHA and VA, are sold in Ginnie Mae pools. But Freddie Mac and Fannie Mae have their rules that lenders have to follow when it comes to pricing. Charge extra for a lower credit score. Charge extra for cash out when you're doing a refinance. That's actually an add-on to the mortgage interest rate. Those are called LLPAs, loan level price adjustments, and they are revised, and they will begin with delivery of loans on May 1st. So we'll start seeing lenders price those in as early as March, because then they have to deliver those loans, and anything after May 1st is going to have those increases in it. So that's not great news when it comes to mortgage rates. We see some positive indicators of mortgage rates, but they're changing the rules. They're shaking things up a little bit. And we're going to see things like well-qualified buyers with high credit scores paying a little bit more. The disparity between a high credit score and a low credit score is is going to be shrunk. It's going to decrease. And that's because the administration wants to have more parity. And in essence, really the higher credit score individuals are going to be subsidizing the risk and rates to people with lower credit scores. So however you feel about that, that's coming. And again, with cash out, when you want to refinance, take some money out to buy another property or to improve your property, that's going to be a little bit more expensive as well. One thing that is a little bit odd is that people with small down payments might see a better rate than somebody with a 20% down payment or more. And that is because the shared risk of mortgage insurance protects the lender, protects Freddie Mac and Fannie Mae, because they share in that risk. And so, because you're paying a mortgage insurance premium. And so you might actually see a little bit better rate putting 10% or 5% down than you would with a 20% down payment. And so that's something for us to talk about whenever you're ready to buy a home and what your goal is for a down payment. We may take a look at that, because mortgage insurance can be gotten rid of down the road. When equity goes up, you can get rid of the mortgage insurance, and then you have that lower rate. So a lot of things going on. By all means, give me a holler at 661-714-2145. I know by no means covered everything that's going on in the economy that's affecting mortgage interest rates, but I tried to get some of those key points in for you, and I hope that was helpful. So anybody that you know that needs this kind of information, please forward them the video or let them know about me, or let me know about them. I'd be happy to reach out. You have an absolutely wonderful week, and I will be reporting as soon as I hear on Wednesday what the Fed's results are for the discount rate. Thank you so much.